When a government releases its national budget, you usually expect some big flashy headlines, right? But India's latest budget is making waves for a totally different reason. It's, well, kind of boring. And honestly, that might just be the most brilliant thing for the country's future. So let's get into it and break down why. This quote from an analyst really just hits the nail on the head. The whole point here isn't about grabbing quick political wins or making a splash before an election. Nope. It's all about building a solid foundation for real, compounding growth over the long haul. We're talking about a budget with a 10-year vision, not a 10-month one. So that begs the question, right? Why is boring suddenly a good thing? We're all conditioned to think that big and bold is always better. But when it comes to economics, sometimes the steadiest hand is actually the strongest one. And answering that question is exactly what we're going to do here. Okay, so to really get why boring is a positive, we first have to define what we mean by boring in this context, because it's not about a lack of ambition at all. It's actually about a very specific and frankly powerful strategy.
Here's the core difference. You have your populist budget, which is often stuffed with pre-election freebies. Things like sudden tax cuts or cash handouts designed to make voters happy right now. This budget, it's the polar opposite. It's a continuity budget. That means it's sticking to a long-term game plan that's all about CapEx, or capital expenditure. And that's just a fancy way of saying they're spending money on building real, hard assets, things like roads, ports, and factories that will fuel growth for years and years to come. And look, this isn't just us reading between the lines. This is the government's own stated philosophy. They're literally saying it's about action, reform, and people instead of short-term populism. It's a super clear signal to investors and to the world that the plan is to just stick to the fundamentals, ignore the noise, and build something that lasts. All right, so if the big strategy is all about long-term continuity, what's it built on? Well, the foundation is one of the most important ideas in economics: fiscal discipline. Let's take a look at the actual evidence for this. Now, what's really fascinating here is what's not happening. No big changes to personal or corporate taxes, no flashy new spending sprees. Instead, the focus is all on the quality of the spending, making sure every single rupee is put towards something productive. This kind of discipline is absolutely crucial because it means the government isn't borrowing like crazy. That helps keep interest rates stable, and it avoids crowding out private companies that also need to borrow money to grow and invest. And the result of all that discipline? It's this number right here. The government is confidently projecting a sustained 7% real GDP growth. I mean, that kind of stable, high growth doesn't just happen by magic. It's built on a bedrock of predictable, responsible financial policy. So, with that solid foundation firmly in place, where is all this investment capital actually going? Well, the answer lies in fueling three core engines of India's economy. This chart, this is the absolute centerpiece of the entire strategy. Just look at that jump. Public capital spending is on track to just skyrocket from around 2 lakh crore rupees back in 2015 to over 12 lakh crore rupees by 2027. This is a massive, multi-year bet on rebuilding the entire backbone of the Indian economy. So, growth engine number one that all this money is powering? Infrastructure. And this is about way more than just having smoother roads to drive on. By building out new freight corridors and waterways, the goal is to fix a huge weak spot in the economy: logistics costs. The target is to slash those costs from about 13% of GDP all the way down to under 9%. For every single business in the country, that's a massive boost in efficiency. Engine number two is manufacturing. And again, this isn't just about making more stuff, it's about making higher value stuff. The budget is making a strategic push into really critical sectors like semiconductors, electronics, and biopharma. This is a long-term play to build up domestic capabilities, rely less on imports, and really move India up the global supply chain. And we absolutely cannot forget the third, and you could argue the most powerful engine of all: services. I mean, this sector already makes up a whopping 55% of India's GDP. So this budget is all about future-proofing that incredible strength, investing in IT, positioning India as a global hub for medical tourism, and building up world-class education centers. It's all about leveraging India's single greatest asset, its people. Okay, so you're probably wondering, what does all this mean for the stock market and for investors? Well, the budget did make one very specific change that really affects traders, and it sends a clear signal. It's all about long-term gain over short-term speculation.
Here it is, the hard data. The Securities Transaction Tax, or STT, got an increase. You can see it right here. The tax on futures trading more than doubled, and the tax on options trading also went up quite a bit. Basically, it just got more expensive to buy and sell really frequently. So the real story here is the signal this sends. If you're a high-frequency trader or a short-term speculator, this is probably not great news. Your costs just went up. But the message from the government seems to be aimed at encouraging the exact opposite, long-term investment. By making rapid-fire trading a bit more costly, the policy is trying to improve the overall quality of the market and reward patient investors who are in it for the long haul. It's a classic case of short-term pain for long-term gain. All right, let's tie this all together. We've looked at the philosophy, the fiscal discipline, the growth engines, and the impact on the markets. So what's the final verdict on this so-called boring budget? Well, for the economy as a whole, the verdict seems pretty clear. This is a growth-oriented, disciplined plan that's focused on staying the course. For the stock markets, the immediate impact might be kind of neutral, as traders get used to the new tax reality. But for anyone investing with a long-term view, the message is strongly bullish. Because at the end of the day, a stable, growing economy is the absolute best environment for companies to thrive. And that brings us right back to where we started. This quote just says it all, doesn't it? In a really volatile world, having a steady, predictable, and disciplined economic plan, well, that's not boring, that's a superpower. It's the kind of quiet competence that might not make for exciting headlines, but it is the perfect recipe for excellent long-term wealth creation. And maybe that leaves us with a final thought. Perhaps the most radical economic policy of all these days is simply to have a sensible plan and then actually stick to it.